Hey, what's up, everybody? It's James. So, today we're going to be talking about the 7 factors that can affect your mortgage rate. Okay, so we're going to review the 7 things that will affect your mortgage rate. So, one would be your risk based price adjustment. So, what is the risk based price adjustment? Okay, what it is that if you are at a risk of defaulting, those are key areas that a mortgage lender looks at when determining your interest rate. Like, for example, if you are a high debt person, okay, if you owe a lot of money, or by looking at your credit score, shows that you missed payments, or that you are late on payment. Those are the key metrics that mortgage lender look at when determining your interest rate. Okay. The second thing when determining your mortgage rate is really just your credit score. So your credit score right here is the 3-digit in your credit report, which is Experian, Equifax, and TransUnion. Those key credit report gives them an idea of where you stand in the credit side of the business, which is how risky are you? Okay, are you a low risk, a high risk, or where are you at, right? So the other thing, which is the third thing when it comes down to things that will affect your mortgage rate and people don't know, and there's a lot of things that people don't know, is that the size of your down payment. Okay, so normally the reason why a lot of lenders prefer a larger down payment because it lowered your loan to value ratio, meaning that you're less riskier as a borrower. Okay, so when you put more down, then if even in the event that you default, they, which is the bank, can sell your property and know that they can get their money back. So all of this is really just adjusting risk toward the borrower, the lender. Okay, so they want to make sure that they're getting rewarded for doing the loan. So, and then number 4, right? Number 4 is what type of homes that you're buying. So according to this, are you buying a primary residence? Because if you're buying a primary residence, it's a lot cheaper than buying a secondary residence, or it's a lot cheaper than buying a vacation home, okay, or an investment home, okay. So or a commercial. So understanding what type of residency that you're buying is going to play in a huge part in terms of like your interest rate. Because as a first-time home buyer, you can take advantage of the low interest rate that is associated with that type of program. All right, and then also the amount of money that you borrow. Okay, so as you continue to climb and as you continue to buy the bigger homes that are higher risk, and you borrow more money, the more you borrow, really, the more you'll pay in terms of interest. The higher the interest rate would be. So yeah, so just keep your borrowing down, so then you don't have to pay so much in interest, or so your interest won't be so high. Okay, and then also what determines like your mortgage rate is by if you're planning to buy interest points down or not. Okay, you can buy your interest rate down. Okay, so talk to your lender about that. And then lastly, the 7th thing is that you got to shop around for the best deal. Okay, so look at this article. So according to a Stanford University study, it shows that shopper who gets at least 3 quotes, right, 3 quotes from different lenders, they normally save around a couple of $1,000s on a $200,000 loan. So basically they would save about 1%, roughly, so $2,000 roughly, which is really good. And then also, when you're talking to these lenders, you want to make sure what kind of programs that they're running, okay? Because not all lenders are the same. Just like not all real estate agents are the same. Some of them are really good at just Fannie Mae and Freddie Mac, like traditional, conventional FHA like loan programs, and other lenders have different products, like for example, like a 12-month bank statement loan, or like a self-employed statement loans, or just or just a 20%, 25% down, no question ask loan, or just a hard money lender where they just required a certain amount down, right? So there's a lot of different types of lending programs out there, and everybody needs different things depending on where you're at in life and what you're currently doing. So anyways, hopefully this helped. Definitely there's certain things you can do out there to reduce your mortgage rate, but one of the best thing is that, you know, just buy the house during, you know, low interest time, and then in the future what you want to end up doing is you want to refinance it at a low rate. Okay. I always tell my client that it's better than renting, because when you're renting, you know, home price would continue to go up in terms of like your rent payment. When you do buy a home, at least you can, you know, your mortgage will stabilize. So anyways, hopefully this video helps. Anyways, this is James. Peace and love, guys, and you know, hopefully that you know, you guys got some value from this. Anyways, peace and love.